Let's begin with our market panel. BD8 Capital Partners CEO Barbara Doran and Jefferies Chief Market Strategist and CNBC contributor David Zervos. It's good to have you both here. David, I'm going to start with you because we went back and forth in stocks post-Fed and as Powell was talking in his press conference, but major averages, with the exception of the Russell 2000, finishing the day lower. You had yields across the curve higher, dollar weaker, gold reaching a new record, too. What does this tell us about the market's, at least initial reaction to what we heard today?
Well, actually, Morgan, I think you're 100% right, although the dollar strengthened quite a lot in the end. Dollar-yen was higher, and the euro-dollar weakened. So it was really a risk-off story. And I think you can trace it to two things. One is the dots in 2025 weren't that exciting for the market. The Fed isn't getting to neutral as fast as many had hoped. And they sort of front-loaded this move before an election. And I think there's a few conspiracy theorists, skeptics out there that are going to say, well, wait a minute, that looks a little fishy. And the 10-year note doesn't like fishy. So you got a lot of mixed messages and probably a reaction, Morgan, that the Fed is not very happy about it. They wanted to put more easing in financial conditions into the marketplace because they were worried in taking out an insurance policy. A stronger dollar, a higher 10-year note, a higher 2-year note, and weaker stocks didn't happen.
And I'm glad you brought up the fact that the dollar actually ended up reversing course and strengthening again, because it really speaks to the market move we saw after this jumbo-sized cut by the Fed, Barb. I realized there had been the case building and markets had been pricing in the possibility that we got 50 basis points today. Powell was also pretty strong in saying in the press conference that, you know, this is not the start of more 50 basis point cuts. And obviously we can look to the dot plot, too. And I thought the point that David just made about the Fed basically taking out insurance was pretty notable. How do you see this shaping up from here?
Well, you know, I think if the Fed had just done a 25 basis point cut, I think the market would have gone down more. I think the 50 bips is the right thing to do at this moment because Powell made it clear the economy is strong. They feel that inflation is going to continue to come down. And they do have, but they're worried about labor. It's now 1-for-1 in jobs. You know, they've got different job openings that are not, there's not layoffs that are happening. So I think the Fed really is taking out an insurance policy because they don't want to wait till they see layoffs. They don't want to wait till see they have a big drop. So I think they're trying to make sure that they keep the economy on even keel. And he's given plenty of signals this last 6 months about that. So I think the market could switch around here because I think the focus now will be, since they did not lay out a clear path of what would happen next, what I heard was basically that they're still going to remain data dependent. And if they need to, inflation perks up, they'll do something. If labor suddenly slows, they'll do something else. But so I think it means more volatility, but we're also going to have to focus on earnings. And so far, you know, it looks that we are not hearing companies coming in any outsized way in trimming estimates for the next quarter coming up or next year. So I think the focus is going to return to earnings. And we start in mid-October with the next quarter's reports.
David Zervos, I realize that it can take a couple days to fully digest, for the market to fully digest what the Fed has done and said. But I noticed in the minutes, a couple hours after the 50 basis point cut came out, the tech sector of the S&P immediately shot higher and then gave that up and closed, second lowest sector of the day. Consumer staples and utilities dropped immediately. What do you make of that?
I think the sector stuff is harder, even harder than just getting that market average right. So I wouldn't get, as you said in the opening there, I wouldn't get too caught up in the first hours of trade. That said, this is not the reaction that the Fed would like to see. I don't think this is the market reaction that those in the 50 basis point camp wanted to see. I don't think they would have thought the 2-year note was up in yield. I think the market did not like this move. I think if they got a 50, they probably would have liked to hear that the Fed was in a hurry to get to neutral. So you got a really weird message, John. You got this message that we're not in a hurry to get anywhere. In fact, Jay sort of said that. There's nothing in the projections that suggests we're in a rush. But then today we were in a rush. So I thought it was a super confused message, and the market is acting in a super confused way.